Please give an overview of the current trading environment for listed futures in Asia.
The current trading environment in the futures market in Asia is good, but I wouldn't say it's spectacular. I think there was an expectation that 2010 would see the futures markets really climb out in Asia as a result of post-GFC and a little bit more appetite for risk. Well, first and foremost, we didn't really get a lot of risk events in Asia that would drive a lot of volatility and a lot of investment into the futures markets. Where we saw the volatility was in Europe through the European debt crisis, and that was really, in May of 2010 was the most active period in futures markets generally. In the second half of the year, volatility actually declined, and the factors for that were the European debt crisis was dealt with, China was growing strongly and as expected, and the US was starting to see the recovery come through, albeit in a very steady, unspectacular fashion.
Now, what is driving the demand for listed futures in Asia?
Well, demand for listed futures is driven by volatility, and you need volatility, and you need risk events, you need reasons for speculators, hedgers, traders to make decisions and transact in the futures markets. And that's particularly in Asia as much as it is in US and Europe. What I think we're seeing right now in the first part of 2011 is something that hasn't actually been priced into the market and will create volatility in my view, and that's the geopolitical climate we've suddenly seen emerge rather rapidly out of North Africa. You've seen Tunisia overthrow its government, you've seen Egypt, an astounding overthrow of Mubarak after 40 years, and you're starting to see Libya now starting to, see demonstrators on the streets in what are really autocratic governments. This is significant. But most significantly is we've seen in China some emergence of some domestic protests which have been reported as much as last weekend. And that, if it starts to grab some momentum, could be a big issue for the markets to deal with, as China is such a key part of what happens in Asia in 2011. The volatility in Asia in the beginning of 2011 is probably not as we had expected, given the investments that a lot of people had made in the region. 2010 was a rebuild year for a lot of people, and a lot of hope came out of Asia, and particularly within the listed derivatives markets, that we'd see almost an explosion of activity. Now, where there's been really good strength is in the commodity markets, and that is really driven by China and India, where they are the main buyers and traders in these particular products. But just about every asset class along the soft and hard commodities are up and on records, and that's been a significant contributor to the development of the futures markets. And already in 2011 we still see that as a prime focus for Asia, is the commodities futures markets, and we'll see the SMX, we see the Hong Kong Mercantile Exchange, all trying to develop products to take advantage of the development of the commodities business in the region. On the financial side, equity markets are more steady in their return to activity, and interest rates, Japan and Australia, interest rates as we know globally are fairly flat, so we're not seeing a huge amount of activity in the interest rate futures market.
What is the impact on risk management by the shift to listed futures in Asia?
Well, we saw with the global financial crisis that the shift towards listed futures was driven by a fear that OTC products were not transparent enough and were not being managed from a risk perspective very well. And it was one of the reasons that regulators started to say that we need to control systemic risk by ensuring that we consolidate and make transparent a lot of these OTC products onto a central clearing counterparty like an exchange. And that is actually developing, but the concern I have about that, and the concern I think the industry is seeing, and we're seeing some things emerging out of this, is that by consolidating all of the risk into a central clearing counterparty, you might reduce the systemic risk by having one outlier failing, but then you have this massive counterparty with an exchange that will require an enormous balance sheet to be able to absorb the counterparty risk, not only on the listed contracts but also the OTC business that they're looking to pick up. And one of the outcomes of that particular development is we're seeing exchanges looking to rationalise and merge to ensure that they're big enough to be able to compete in this space. And in the region, of course, the biggest one we've seen most recently is the announced merger, should I say, between the ASX and the SGX, which is yet to be approved, but it's a sign that exchanges in the region need to know that they have to get big if they are going to be able to develop product and to be able to handle the role as a central clearing counterparty, not just for listed products, but also for OTC products.